Everyone on YouTube is talking about which REITs to buy now that interest rates might be falling, but they're missing the real story. While most investors expect slow, steady rate cuts, Wall Street almost never prices in a reversal. But that is far from a guarantee. In fact, if you peek behind the curtain at the Fed's own projections, you'll see deep divisions among its members, with forecasts all over the map, ranging from no cuts at all to more aggressive ones. So what if they're wrong? What if inflation proves stickier than expected, or the economy stays too hot, forcing the Fed to hold firm or even reverse course? A sudden change of plans could spring a trap on dividend investors who aren't prepared. And when that happens, a lot of high-yield REIT dividends will be in serious trouble. This video is your guide to spotting the vulnerable REITs and protecting your income before the trap is sprung. We're not just looking for juicy yields, we're looking for survival. So if you're a REIT investor or thinking about becoming one, and you want to make sure your dividend income is safe no matter what the Fed does, then stick around. And hey, if you appreciate this kind of forward-looking analysis that helps protect your portfolio, do me a quick favor and hit that like button. It really does help the channel and gets this info in front of more investors like you. So what is this trap I'm talking about? It's a nasty two-punch combo that floors vulnerable REITs when interest rates go up unexpectedly. Punch number one is a direct hit to their profits. Most REITs, that's real estate investment trusts, work by borrowing money to buy properties, which they then rent out. The difference between the rent they collect and their loan payments is their profit, and they're required to pay out most of that profit to you as dividends. It's just like a mortgage. If you have an adjustable rate mortgage and rates suddenly spike, your payments can shoot up, eating into your cash. For a REIT, this means higher interest expenses. As their borrowing costs rise, the cash flow they have left to pay you, what we call adjusted funds from operations, or AFFO, gets squeezed. If it gets squeezed too much, the dividend gets cut. The second punch is a little more subtle, but just as painful. Competition. When interest rates rise, the return on safer investments like government bonds also goes up. If an investor can get a guaranteed 5% from a risk-free treasury bond, why would they risk their money on a REIT for a 6% dividend that might get chopped in half? They wouldn't. Demand for REITs dries up, their stock prices fall, and your investment shrinks, even if the dividend survives. That's the trap. Rising debt costs and falling investor demand team up to crush your total return. Not all REITs are built to handle this pressure. Historically, sudden rate shocks have led to dividend cuts, and the key is knowing which ones are going to crack first. So where should we look for the biggest cracks in the foundation? Certain sectors are just structurally weaker when rates rise. Let's start with the most obvious one. First up are office REITs. This sector is facing a perfect storm. The work from home trend caused a huge drop in demand that isn't going away. This has left office buildings with high vacancies and falling rents. Now add rising rates to that mess. These companies have mountains of debt they need to refinance. Trying to roll over that debt in a high-rate world while your rental income is weak is a recipe for disaster. It can force them to sell properties at a loss or suspend dividends just to stay afloat. Even a major player like Boston Properties, BXP, with its huge office portfolio, is exposed to these sector-wide pressures. While its payout ratio isn't in the immediate danger zone, the fundamental weakness of the office market creates a massive headwind. And this is where the mistakes get more subtle. Next, let's talk about retail REITs with shaky balance sheets. I'm not talking about the owners of high-end luxury malls. I mean REITs that own strip malls and shopping centers in areas with low growth, often with a lot of debt. Their business model relies on leverage, and their leases are often shorter than other property types. This means their borrowing costs can jump up much faster than they can raise rents. For example, a major player like Kimco Realty, KIM, has significant exposure to open-air shopping centers, and its AFFO payout ratio has recently been high, at times pushing 90%, which signals potential stress if borrowing costs were to jump unexpectedly. Finally, we have to talk about the most sensitive sector of all. Mortgage REITs, or MREITs. These are a completely different animal. Unlike the REITs we've discussed that own buildings, REITs own mortgage-backed securities. Their entire business is a spread game. They borrow money at short-term rates to buy higher-yielding mortgage assets. When rates are stable or falling, it's a money-making machine. But when rates rise, it's brutal. Their borrowing costs can rise overnight, while the value of their long-term assets plummets. This spread compression absolutely destroys their earnings and leads to famously volatile dividends. For instance, Annaly Capital, NLY, might tempt you with a yield around 12%, but that high yield isn't a gift. It's the market quietly pricing in a future cut. It has a long history of cutting its dividend when rates spike. Its dividend payout is also uncomfortably high, representing nearly 98% of its cash flow. For REITs, a rate bounce back isn't a risk, it's existential. Now that you know where the weak spots are, how can you test the dividend safety of any REIT in your portfolio? This is the most practical part of the video. I'm giving you a simple 60-second stress test you can run on any REIT using public info from their investor website or sites like Yahoo Finance. And once you see this checklist, you'll never look at yield the same way again. This isn't just a checklist, it's a survival framework. It has 5 key questions. Question 1, how much of their debt is fixed rate? You want to see that over 70% of the REIT's total debt is at a fixed interest rate. This is their shield. If rates jump, it only affects the small slice of floating rate debt or any new debt they take on. A REIT with over 50% floating rate debt is playing with fire. Question 2, are they facing a debt maturity wall? Look at their debt schedule. If more than 20% of their total debt is due for refinancing in the next 2 or 3 years, that's a huge red flag. We call this a maturity wall. It means they'll be forced to get new loans at what could be much higher rates, putting a ton of pressure on their cash flow. You want to see debt that's spread out evenly, far into the future. Question 3, what's the AFFO payout ratio? This is the single most important metric for dividend safety. It tells you what percentage of the company's real available cash is being paid out as a dividend. A ratio below 85% is generally healthy and suggests a cushion. Anything over 90% is in the danger zone. And a yield over 12% is almost always a sign of a dangerously high payout ratio that is likely unsustainable. Question 4, what do their leases look like? Look for an average lease term of more than 5 years. Long leases lock in predictable income. Even better is if those leases have built-in rent increases of 2% or more each year. This makes sure their income grows over time, helping to fight off inflation and other rising costs. Question 5, do they have pricing power? This is a bit more qualitative. Does the REIT own properties that are so essential or rare that they can tell tenants what the rent will be? Think data centers, cell towers, or top-tier logistics warehouses. These are businesses with real pricing power. A REIT that is a price taker, not a price maker, is going to struggle. Let's take Annaly Capital again. It would fail this test spectacularly. It uses short-term borrowing, making its debt highly variable, and its income is totally dependent on volatile rate spreads, giving it zero pricing power. A REIT needs a strong yes on at least 4 of these 5 points to get a passing grade. A REIT that passes is a fortress. A REIT that fails is a house of cards. So, what does a fortress actually look like? After weeding out the weak, you have to find the strong. These are the REITs that pass the stress test with flying colors. You'll usually find them in sectors with unstoppable long-term demand. Take the industrial logistics sector with a giant like Prologis. The growth of e-commerce has made their warehouses and distribution centers essential. Prologis breezes through our stress test. It has long-term leases, a high percentage of fixed-rate debt with an average maturity of over 8 years, and a manageable debt-to-equity ratio. Its AFFO payout ratio is consistently safe, and its global scale gives it huge pricing power with tenants like Amazon and FedEx. Next, look at digital infrastructure with companies like Equinix, EQIX, which runs data centers. In our digital world, data storage is non-negotiable. Equinix has long lease terms, and it's a massive pain for tenants to move their digital operations, giving Equinix a stable, growing revenue stream. It maintains a robust balance sheet with investment-grade credit ratings and has a history of dividend growth. Another great example is in communications infrastructure, with a leader like American Tower, AMT. This company owns the cell towers our lives depend on. Its tenants are major telecom companies that sign very long-term leases, often with rent increases built right in. This creates an incredibly predictable cash flow. American Tower maintains an investment-grade balance sheet and a disciplined financing approach with well-staggered debt maturities, protecting it from rate shocks. These companies, Prologis, Equinix, and American Tower, aren't just built to survive, they're built to thrive. Their businesses are resilient, their balance sheets are strong, and their dividends are secure precisely because they have the traits we looked for in our stress test. They focus on mission-critical assets, which gives them the stability to navigate a world of changing interest rates. When interest rates get shaky, not all REITs are created equal. The market's excitement about potential rate cuts has made people complacent, but hope is not an investment strategy. We have to prepare for the unexpected. A surprise rate reversal could punish investors who chase the highest yields without checking the foundations. The main takeaway is this: you must prioritize a strong balance sheet and dividend safety over a tempting yield. By using the 60-second stress test, checking for fixed-rate debt, staggered maturities, a safe payout ratio, long leases, and pricing power, you can go from being a passive yield chaser to a truly resilient income investor. Focus on the fortresses, not the houses of cards. That's how you protect your portfolio and make sure your dividend income survives, no matter which way the economic winds blow. If you found this guide helpful, make sure you subscribe so you don't miss future videos where we break down complex market trends into actionable strategies. And I've got a question for you. What's more important in your REIT strategy right now? Maximizing yield or guaranteeing resilience? Let me know in the comments below. Thanks for watching. The highest yield isn't always the best income. The safest income is the one that survives.